Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. I am here with you this day to talk on terminal value technique of capital budgeting. So, this is the last technique we will be discussing in this topic of capital budgeting. So, in the past we have discussed about discounting and non-discounting technique, non-discounting both accounting rate of return, and then we have discussed about the payback method. In the discounting technique we have discussed net present value method, we have discussed PI, profitability index method, and this last method we want to discuss is the terminal value technique. So, what is terminal value technique? So, this terminal value technique is actually it is known as a technique where we are not only discounting the inflows, in fact we are discounting after compounding of the inflows, because the inflows are received across the duration of the project. So, which means if I am getting X amount today after 1 year of the project beginning, that is my cash inflow, and but that 1 year amount whatever I receive 10,000 or 20,000, that is going to give me some return in terms of interest as well. So, I can earn something on that as well basis on the available rate of interest. So, what we do, we add up that expected interest as well, and then whatever the compounded value is there, we discount that compounded total value. So, this is the only technique in capital budgeting where both compounding and discounting are used. So, let me explain this. In discounted cash flow analysis, the terminal value is often significant portion of the total valuation. So, sometimes accounting for a majority of the present value. The same concept is used in capital budgeting decision. So, try to understand discounted cash flow DCF analysis is the very common technique, very important technique, right. The terminal values, the significant portion is there of the terminal value in the total valuation of any proposal, right. So, what we do, we are actually using DCF in this formula, in this technique, and in finance as I said, the terminal value of a security is the present value at a future point in time of all the future cash flows including interest earned. So, important is my focus is, my emphasis is on the interest earned, because none of the other capital budgeting techniques considers the interest earned. So, it is a crucial component of discounted cash flows analysis, particularly when the projecting cash flows over a long term horizon, because if we are expecting cash flows for 20 years, a project could have a life of 20 years, 30 years, 100 years even, right. So, if the project has a life of 50 years, 20 years, in that case this cash flows of interest becomes very, very important, because it means in the 50 years in future you are going to earn not only the revenue from that project, but the interest on that revenue as well, right. So, that is why it becomes very, very important component that we discount the interest as well, which we receive after compounding, after of course including the interest. So, in the terminal value method TV, it distinctly separates the timings of cash inflows and outflows. The assumption behind this approach is that each cash inflow is reinvested in another asset at a certain rate of return from the day it is received until the termination of the project. As I said a minute ago, let us say I invested in a new machinery. So, machinery we are using in production, okay. So, I am using that machinery in production, and out of that machinery whatever I am producing, I am selling it for let us say 50,000 rupees per unit, and to manufacture that particular unit or the product, we are spending 30,000. So the net cash inflow from that product is, that additional product revenue from that product is 20,000. Okay, so that is the incremental cash revenue we are getting from the project. So now that 20,000 being received today, you would be, and the life of the project is 10 years. So you would be investing that 20,000 next year, then next year, then next year. The amount which we received for the first year, after the 1 year of the project, that would be reinvested for 19 years. We will be getting interest on that amount for 19 years. I may put that in bank, I may put it in shares, I may put it in dividends, in debentures, in anything, or in another building even. So I may use that for any purpose, but whatever I earn in the first year, that is going to give me interest for 19 years. Whatever I earn in the second year, that is going to give me interest or returns for next 18 years. Third year, whatever I earn, that gives me interest for 17 years. So because the life we assumed is 20. So the terminal year is 20th year, because whatever I invest in the first year, that will be giving me interest for 19 years. It's -1, because the first year at the end we are receiving it. That's what that's how we are assuming it. So it means first year receipts are invested for 19 years, second years are invested for, and if the life of the project is 5 years, then the first year receipts will give me 4 years interest, second year will give me 3 years, the third year will give me 2 years, the fourth year will be giving me 1 year, and the last year returns will not give me any interest, because then it will be 0 years. So this is the whole concept of terminal value method. Okay. So the premise of the DCF approach states that an asset, the company could be, as per DCF analysis, it could be a company, a project, a plant, a machinery, is worth the sum of all its future free cash flows, FCFs, future free cash flows. So any project which we are evaluating, because now we are using DCF in capital budgeting, right, in this discussion. So this becomes the premise that all the future free cash flows, their sum, the worth, so the total worth of whatever the value, total worth of that inflows, that must be discounted, not only the relevant cash flows from that project, but the interest also. Okay. So what is the criteria to accept or reject under this technique? If the present value of total sum of all the cash flows is greater than present value of cash outflows, PVO, right, PVTS and PVO, these are the two terms we use. If it is greater than PVO, accept it, else we should reject it. If PVTS are less than PVOs, reject it. So this is the decision criteria, decision rule used in the technique known as terminal value technique, which is based on DCF, discounted cash flow method. So let's take a small case now. This is the caselet on terminal value. There is a project outlay for 12,000. Life of the project is 5 years. Cash inflows is rupees 6,000 each for 5 years. So rupees 6,000 each for 5 years means annuity. Cost of capital K is 10%. Expected interest rates at which the cash inflows will be reinvested, 6% for the year 1 and 2, 8% for the year 3, 4 and 5, 3 to 5. So this is the small caselet I have given to you. Just have a look at the data carefully. Project outlay is how much? 12,000. In total what we are spending today is 12,000 outlay, right? Outflow or outlay is the same thing. How much is the life? 5 years, and the inflows we are getting in the form of annuity. Every year 6,000, and discount rate is given 10%. and the expected interest rate is different. For first 2 years we are expecting 6%, then third, fourth, fifth year we are expecting 8%, right. This is the summary. So, how would we solve this case? Let us understand, let us see that. So, the caselet, as I said, in the top we are writing the outlay 12,000, just because just to put it in the one slide I have done that. So, in the first column we are taking year 1 to 5, then we are taking cash flows after tax 6,000, no tax is mentioned in the case. I have taken a very simple example, right. So, we have cash flows after tax 6,000, in total 30,000. So, and then the rate of interest which will be giving giving us as interest while reinvesting it is 6%, 6% for first 2 years, 8% for 3 to 5 years. In the fourth column, we are showing the year of the investment, that particular cash flow which is received in the first year will be invested for how many years. That is what the fourth column is showing. So, as I said, the life is 5 year in this case, right, and so the whatever we receive in the first year, by chance we are receiving 6,000 every year, we may be receiving different amount different years, right. So, the whatever we receive in the first year would be reinvested for 5 minus 1, because we are receiving 6,000 at the end of year. All the cash flows are expected to receive at the end of the first year. So, first year, second year and so on. So, this would be reinvested for 4 years. Same way, whatever we are receiving, that is 6,000, that would be reinvested in for 3 years. That is how the second row in the solution is 3. Whatever we are receiving in third year, that is 6,000 again, that 6,000 will be reinvested for 2 years. The 6,000 received in fourth year would be reinvested for 1 year, and 6,000 received in the terminal year, the fifth year, will not be reinvested. So, that is why it is 0 in the last row. So, 4, 3, 2, 1, 0. So, now we will go to that compound value table for 1 rupee and we will get the factor. The factor is 1 for 4 years, the factor is 1.26 and so on, 1.191, 1.166, 1.080 and 1.00. So, because discount factor for last year, the fifth year is always 1, for today it is always 1. So, 1.000, that is 1. Okay. So, now let us multiply the compound factor CF, the value given in the fifth column, with the cash flows after tax given in the second column, 6,000 each, right, and we will get the total compound value. This would be the compound value. So, compound value is coming out 7,572 and so on. Compound value is different every year, though the cash flows were same. Because why? Because cash flow are different because of the factor we are multiplying is different every year. Okay. So, the total of cash flows which are compounded here is 34,194. You see the difference? The total of cash flows without compounding, without considering the interest was 30,000, right. Had it been any other technique, be it profitability index or net present value, we would not have considered interest. This is the only technique, as I said, we are using interest. So, now my cash flows are not 30,000 which I am going to discount, but they are 34,194 and now we will be discounting them. So, the total compound value over years is 34,194. This will be discounted at the discount factor for n year 5. So, n is 5 and the discount rate given in the case is 10%. So, the factor is 0.621. Where it is coming from? You can actually check it right away while listening to the session lecture. So, go to the discount table, look at the discount factor for 1 rupee and look at the N5 row and column, right, N5 and rate 10. So, look at the where 10 and year 5 is given. So, you will see 0.62 is there, that discount factor is there. Otherwise, you can use a financial calculator and you can actually discount it with the help of calculator as well. So, if we discount 0.621, multiply 0.621 with 34,194, the discounted value of this terminal cash flow is coming out 21,234. So, thereby project is recommended for consideration. Why? Because this PVTS is more than what we are spending. How much we are spending? 12,000. So, my outlay in the project is 12,000. My inflow, which is after considering interest, after discounting as well, is more, which is 21,234. So, this is a very good technique where we are actually considering inflows, outflows and the interest as well. So, so if we look at this value of PVTS, which is higher than PVO of 12,000, so it is recommended that company should accept the proposal, right. So, this is the conclusion. So, after this discussion, now I will be talking about merits and demerits of this PI technique. What are the merits of PI technique? The first one is this is a realistic approach for reinvesting cash inflows. Number 2, this is the mathematically easier to calculate. Number 3, easy to understand, and number 4, actually consider interest earned. So, let me explain these points to you now. So, this is a very realistic approach. Why? A realistic method, because none of that technique, as I said and I say again, none of the technique actually consider reinvesting of cash inflow. You name it. The most commonly used technique is net present value, but it does not consider reinvesting at all. Okay. So, the only technique in capital budgeting which considers reinvesting is the technique of PI, present value method, and that is why we call it as a realistic, and because everything, outflows, inflows and the interest, possible interest to be earned is considered. So, it becomes a real technique. That's the first benefit. The second is that mathematically very easy, because compounding is something everybody understands. You know, earning interest on interest is something which everybody understands, and compounding is easy as well. So, mathematically it is very easy, because we are comparing the value which is discounted value of cash inflows, but including the interest, right. So, it becomes easy to calculate and easy to understand as well. That is the third point, because you know, any businessman, you know, we call it as Lalaji in my lectures, in my classroom, I generally say, you know, the Lalaji would understand the easy language. So, he may not be well versed with the financial terms. This is the finance officer, the finance guy who is looking after calculation, etc. But since interest rate is something everybody, even a kid would understand, a kid at 8th level would understand that what is the interest. So, that this becomes very easy. Then we are comparing the actual inflows, considering all the aspects with the outflows, and our results would be more reliable. And last benefit is that this actually is interest earned is actually incorporated, unless because other techniques, for example NPV, they assume the technique, in this technique, that cash inflows are reinvested at the same rate, which practically is not true, because here we are able to imagine the project's life 50 years, 20 years. There is no possibility in most of the country in such a vulnerable situation today, such a hostile environment, business environment today, that interest rate would remain same. Since we can incorporate interest rate on yearly basis, our actual interest would be close to reality, because if the good analyst is actually using this technique, he would know that after some time, after how many years generally the recession comes, so interest rate will go down or go up. We can actually rely on the forecast of the returns expected in the market for next 5, 10, 20 years and actually use a different interest rate for different year. We need not to have an assumption, like NPV, that they are invested at the same rate, which is the assumption only. But here we are actually embedding different interest rate in different year and then calculating the compound value in total, and lastly then discounting. So these were the merits. The demerits, there are 3 demerits primarily. The first one is need to know the discount rate. Number 2, difficult to predict future returns rate, and number 3 is it involves both discounting and compounding. So let me explain them to you. So the first demerit is that need to know the discount rate. As I said in the past as well, I repeat again, discount rate is not given in the exam questions. A student finds discount rate in the question given, like for example in the case we were given the discount rate of 10%, 5%, 7%, whatever it may be. But think in reality, do we have a discount rate given for every company? Who gives it? No, none. Nobody gives the discount rate, and the whole technique is based on discount rate. In fact, not only this, all other discounted techniques, be it net present value or IRR, they all are based on the discount rate. What is the source of discount rate? In fact, you should be questioning us, you should be questioning your teachers, you should be thinking of yourself, where does it come from in reality? In reality, discount rate is considered the rate of the cost of the funds company actually uses. Every company uses different types of funds, be it debt, be it equity, and the cost of debt equity is different to every company. The same industry, we would have a company which has been there from the last 30 years, has a good, very good strong goodwill in the market. They are able to get the funds for the similar project at a lower rate than another company which is a new company, has less goodwill in the market. So, and for the same project. So, I am bidding the same project, the other company is also bidding the same project, and the discount rate would be different for both the companies because the cost of capital is different, right. So, the whole technique in fact is dependent on the discount rate. You need to know it, you need to calculate discount rate beforehand before you apply this technique or any other technique. And then the second thing is in the rest of the techniques we were using only discount rate. Here we are using the future returns to be to be compounded as well. So, we need to, which means we need to forecast that I would be able to get these much returns and I would be able to earn this much interest on those returns. Two things. Future returns are to be forecasted in rest of the techniques as well, and so is here, which is also again uncertain and difficult, but nevertheless here we have to forecast the interest rate as well, the possible interest rate, which may not be accurate. If if there is a lot of difference, you can imagine your whole calculation will be incorrect, your decision will prove wrong, right. So, it is because it is difficult to forecast or to predict the future returns. And the last thing is it involves both discounting and compounding. This is the only technique where both discounting and compounding are used. So, people who use it, practically it is a very good technique, but people who use it for the calculation purpose, they say it is rather more difficult because it uses both the techniques of time value money, both the concepts of time value money, discounting and compounding are used. So, these were the demerits of the technique. With this, we have come to end of discussion of capital budgeting techniques. We have discussed in detail in the past all the methods, be it discounted methods or which are also known as modern techniques, and the non-discounting methods as well. And in future we would be spending some more time on while incorporating risk into the capital budgeting decisions. So far we have not discussed any of the technique where risk has been incorporated. So we will be spending the future sessions with risk analysis as well, combining risk and capital budgeting techniques. So my friends, I hope you could understand the concept of terminal value method. You could understand the merits and demerits, which I have critically reviewed for you, and we have used the case as well. So I hope it is it is understandable to you with the help of case as well. It was helpful to you. So time to wind up, friends. Thank you very much.